Thank you all for dialing in. We have a large number of people who have registered, and we'll just give people a little time to come into the room. Due to the large number of guests, we will not be taking questions from the audience and would ask that you direct all questions after the call to your CBA Relationship Manager. I would now like to hand the call to Chris Mclachlan, Executive General Manager, Global Markets at CBA. Please go ahead.
Thank you and good morning everyone. Thanks for joining us on this RBA economic update call. The Reserve Bank, of course, rose interest rates yesterday with a rise of 25 basis points, increasing the cash rate to 3.1%. That was a widely anticipated move, and we're now sitting at the highest cash rate since 2012. I think whilst that move was widely anticipated, the outlook is really fascinating at the moment, and I think we're all sort of thinking forward to next year and thinking about what that might have in store for us. Market expectations have changed a lot in terms of the forward outlook for both the RBA and interest rates more broadly. So it'd be really good to unpack some of that on this morning's call. We really appreciate everyone dialing into these calls. We've had a number over the year. Obviously, it's been a very eventful year in terms of inflation and monetary policy. So it's been great to have you all on these regular updates, and hopefully you've found them all useful. This morning, we welcome back Commonwealth Bank's Head of Australian Economics, Gareth Aird, who has been, so prominent in the market in terms of calling the RBA's activity. So great to have Gareth here again. Gareth, last RBA announcement for the year. Hopefully we all can look forward to a little break between now and the next one. But why don't we kick off with a bit of a rundown on your thoughts on yesterday's announcement and where this sat in terms of market expectations?
Yeah, sure. Look, thanks, Chris, and hello to everyone who's on the line. As Chris mentioned, we had another 25 basis point increase in the cash rate yesterday, which took the cash rate to 3.1%. So that means that the RBA has now delivered 300 basis points of tightening over 8 meetings, which is just 7 months. So it's been quite an extraordinary period in terms of interest rate hikes. If we go back to the beginning of the year, the Reserve Bank was basically saying there were certain scenarios where it might be plausible that they could raise interest rates, and yet here we are today with a cash rate of 3.1%. The move yesterday was pretty much anticipated by everyone in the market. The market, though, hadn't fully priced a 25 basis point hike because the market was pricing in a small chance that the Reserve Bank could leave policy on hold, given over the last month, the Reserve Bank at every opportunity has flagged the idea that they're willing to pause in the tightening cycle. But most analysts and indeed people in the market thought a December pause would just be too early, given everything that's gone on. And so that 25 basis point hike really came as no surprise to anyone yesterday. When you get a move like that, which is very much in line with expectations, it then all becomes about what has the governor actually said in his statement. And I think there's a few things really that are worth pointing out there. The first is that the RBA governor is still running with the narrative that he wants to keep the economy on an even keel. And he's reiterated that the path to achieving that is a difficult one or a narrow one, but he's trying to engineer a soft landing. That's not the approach that every central bank around the world is taking. And the obvious one there that contrasts with the RBA is the RBNZ, where over in New Zealand, the Reserve Bank there has basically said they're going to run hard at inflation at all costs, basically engineer a recession in order to get inflation down. Now, the Reserve Bank is not taking that approach. To use their words, they want to preserve most of the gains that we've had in employment over this period. The unemployment rate's very low. They don't want it to go up too much, and therefore they've stepped down the pace of tightening. They've obviously still increased interest rates, but they're still trying to get this soft landing, which becomes increasingly hard with every additional rate hike that you deliver. In terms of the key final paragraph in the statement, which is really the paragraph that is where the governor talks about the outlook for monetary policy, he's retained the line that the board expects to increase interest rates further over the period ahead. We thought there was a chance he might have dialed that language down to something like the board is likely to increase interest rates over the period ahead or is willing. But he has maintained that line that they expect to increase interest rates. but he also added that they're not on a preset course. They had talked before about not being on a preset course, but by elevating that statement to the final paragraph, I think it's really about the governor stressing the optionality that the board has from this point to leave policy on hold at any given meeting, and then watch and see how the data evolves, given a lot of the economic data that we're looking at the moment isn't picking up much of the already delivered rate hikes. Look, I think just in terms of what we're expecting from here, we had said going into yesterday's meeting that we were thinking 1 or 2 more rate hikes in this cycle, and then the RBA basically being done. So we're looking for a terminal rate of around 3.1%. But given the governor yesterday reiterated that idea that they're expecting rates to go up further, we thought the prudent thing was to drop in 1 more 25 basis point hike into our base case. And so now we're looking for a peak in the cash rate of 3.35%. That's a little bit less than the market's got. The market is looking for a peak in the cash rate of around 3.6%. But we're not too out of alignment now. There was a period, if you go back a couple of months, and to your point, Chris, around how the market has rallied, where the CBA view looked quite different from what the market had priced, given the market was looking for a terminal cash rate more like 4.4%. But that's come in a lot. And so where we are today is actually not too out of alignment with what the market has got priced. That might be a good place to pause, Chris, and I'm happy to hand it back over to you.
Yeah, I think there's quite a bit to unpack here. I mean, just so the quantum of change that you just talked about there in terms of market outlook versus perhaps where you've been and where we think the RBA outlook is settling is actually huge. I mean, so for you look at sort of not only just the next few months out, but certainly swap rates have seen huge swings. I guess perhaps just before we get into too much in next year, Gareth, I remember Lowe in a speech last month talked about expectations of sort of one last hurrah in terms of spending into Christmas, and probably I've read a few different articles yesterday for people still looking at sort of the risks that spending and demand keeps continuing, but I'm just trying to think of a contrast to your view, which is it's been fairly consistent in terms of expectations. But people could potentially misread the sort of spending momentum into Christmas, because Lowe's clearly said that you've got this lagged effect of rate hikes, and we are expecting some of the spending to be sort of short term in nature. Have you got any views on what we're going to expect out of this sort of demand or data indicators around consumer demand into the year end?
Yeah, sure. Look, I think what the governor said there makes a lot of sense. We had a couple of rough years, and now we've finally got some normality to life. And it's a painful thing to actually have to start spending less. And if you can prolong, spending up and enjoying yourself, you'll probably do it as long as possible. I kind of think of the analogy around a diet. I mean, most people, if they're going to go on a diet, they'll set a date, and up until that point, they'll do whatever they're doing, and then they'll quickly shift and go on the diet. They don't sort of glide path into it. And I do think that it probably is the case that a lot of households will be changing their spending as we go through next year, because they'll have to, simply because they'll need that to find that extra cash to meet the higher mortgage repayments, either if they're on a floating rate, which has been going up, or they're rolling off a very low fixed rate. So they'll have to come up with the additional money, and that'll mean less spending to what they're currently doing. But they probably want to prolong that as long as they can. And I think it could be the case that people either set in their mind a deadline of the end of this year, or potentially the end of January, because people are on holidays and you might want to keep the good times going a little bit over summer. But then you do get that change coming through. That's something we're absolutely anticipating. And there is a risk here, I think, to your point, Chris, that we look at this strong spending data heading into Christmas, and we kind of draw some conclusions that may not be the right one. And that is that, the household sector is just so resilient. The RBA needs to deliver even more to actually get the desired cooling in the economy. I'd just sort of say, in terms of upcoming retail data, we saw the October print, which showed a small fall of 0.2% over the month. But I wasn't willing to draw a lot into that, because we've been shifting our spending patterns over recent years around that October, November and December period, because Black Friday and Cyber Monday have become bigger and bigger each year. And the ABS, who obviously produce our statistics, are having a bit of trouble actually adjusting the data, seasonally adjusting it for that increased spend that occurs in November. Now, the good thing for the RBA is they don't have a meeting in January. So by the time they meet in February, they will have seen both November and December retail sales. So they'll be able to have the full picture of the Christmas period, as opposed to seeing this bumper number for November, which could be inflated just by people pulling forward their spend from December, or delaying it from October to take advantage of the sales. The thing I look at is really the consumer confidence data, which is very weak, which suggests that households are concerned about the outlook, and invariably households that are concerned about the outlook at some point adjust their spending accordingly. And the other thing too is we've just run the sums to see how much money is actually going to be sucked out of the economy via higher rates, and it's a really big shock in terms of the amount of cash that'll be going on to meet these higher interest repayments as a result of what the RBA has delivered.
Yeah, great comments there, and I think when you were talking about your diet analogy, I think there'll be some New Year's resolutions around spending as well as fitness, perhaps. But the important message there is not to misread the data, and you're looking at consumer confidence there as the key signal. So really good points. Maybe just let's just zoom out and set it in terms of the macro. Australia looks at a relative basis to be holding up very well, but sort of broadly sort of outlook for recession and which countries will feel the impact, I guess, the most. And I'll probably assume we're going to look to the US first. But what are your views on which economies are going to feel the impact in 2023 the most?
Yeah, look, it's a fascinating question, because there's really so much to talk about there, and I guess the key thing to frame here is that we're talking about potential recessions coming off full employment, which is a very unusual thing. So we've got incredibly tight labour markets all around the world that is generating higher wages and higher inflation, and then policymakers, as in central banks, have been responding to that by raising rates, and the more they take their policy rates up, the greater the chance of a recession. But it's actually a recession that would be coming about because central banks have engineered it, as opposed to the economy just sleepwalking into a recession, or basically being hit by a negative shock that you can't forecast. So in many ways, it's going to be the central banks of each individual country that decide whether or not their economy is going into recession, and the severity of that recession, and whether or not it's a short and relatively painless one, or they keep policy quite restrictive in order to really get inflation down, really put downward pressure on wages. And what you're then doing by going down that path is actually wanting, or your objective is to push the unemployment rate up to take all the heat out of the labour market. Now, if we go back to New Zealand, that's basically what the Reserve Bank of New Zealand has said. They've said we need to get the unemployment rate up. That's the only way we're going to get wages down, and therefore, and by extension, inflation. And they've penciled in a forecast now for the unemployment rate in New Zealand of 6%, and it's currently 3.5%. So they're talking about massive job losses in New Zealand, because that's what the central bank there thinks that's required. Now, New Zealand's probably on one end of the extreme. The RBA is possibly on the other, where they're still very much focused on the idea of that soft landing. They don't think wages growth is running at the kind of levels that needs them to generate the unemployment rate going up to get it back down. But there is a risk here that we're just lagging a little bit in terms of what's in the pipeline from a wages side of things, and that wages growth does end up at the levels that they think, oh, hang on, we've got a bit of a problem here, because if it gets up to around 4.5%, say, that's just way too high for a central bank that has an inflation target of 2 to 3%. So we're on one side, the RBNZ's on the other side, and then you've got, I would say the Fed, which is kind of somewhere in the middle. They think that they probably need the hard landing, but they also don't want it to be too hard. And it's really the RBNZ that's just gone out there and kind of shocked everyone and basically said we're going to crush things that's the only way we get things down. I think the response of governments here will be really important as we go through next year, because it's all well and good for the central bank to say, we need to get the unemployment rate up to 6% to kill inflation, but it's hard for a government to sit there and kind of accept that number of job losses, and you could see some kind of competing policy objectives as we go through next year. It doesn't feel like that's the case in Australia, but there's always a risk that we end up in that place.
Yeah, so you've covered two really important topics there. I'll perhaps back over a couple of them. I mean, wages, right? And this is a bit of an X factor in terms of a risk to the outlook, isn't it? Because, I mean, and Lowe's talked about this. So, if we're seeing wage rises that are kind of orderly, then that's okay. But we start to see wage rises, as you say, 4%, 5%, 6%. Across big sectors, big sections of the economy, that's going to become problematic, and perhaps in the central bank sort of adopting a little bit more optionality in their narrative. That's something for people to watch for, isn't it?
Yeah, that's exactly right. I think when we think about the CBA house view on the Reserve Bank for just one more hike early next year, the key risk to our view is on the wages side of things, because our expectation is that wages growth in annual terms will have a 3 handle on it next year. You're getting up to around 3.5%, even 3.75%, but that's okay. That's consistent with the inflation target and wouldn't see the RBA take the cash rate deep into restrictive territory. But if we're wrong though, and there's more going on out there than we're actually thinking, I mean, our internal data is consistent with wages growth tracking in that kind of 3.5% range, but when we look at some of the other business surveys, they're a little bit stronger. And talking with corporates, often get a lot of feedback that what's going on in their business is that wages are actually growing more strongly than the official data. So I think if it turns out to be the case that as we go through next year, wages growth is getting up to the uncomfortable levels that mean the RBA needs to go deep into restrictive territory, then the cash rate ends up going a bit higher than we're anticipating. But then with that, you increase the probability of a recession because of that point I was making before. The policy objective then becomes actually to get the unemployment rate up.
And this is where, without going into too many hypotheticals, we just got to keep an eye. If we keep an eye on that topic, you've then subsequently got to keep an eye on this fiscal, the alignment of fiscal and monetary policy. And this government, the federal government, so far been reasonably disciplined, and we obviously saw what happened when there was a break away in terms of that alignment between fiscal and monetary policy in the UK back in October. But that is something to watch as well, because if the government decides to sort of ramp up the fiscal dial to address some strain points in the economy, then that's going to be a factor to consider for the outlook as well, right?
Yeah, absolutely. Again, we talk about risks, and they're basically just things that we've got to keep track of and watch how they evolve, and we're not exactly sure. But I would say the fiscal side is a key risk, because the government to this point, since they've been elected, has been very restrained. They haven't pushed any more money into the economy. They've basically been working in a complementary fashion to the Reserve Bank. But they must be a little bit twitchy to spend some money, because they've been getting so much more coming into the coffers because of these really high commodity prices, and the fiscal position has improved quite radically. Now, so I think there's a risk as we go through next year that the rate of inflation starts to come down. The RBA has been on hold for a while, and the government thinks that's green light for us to be able to spend a bit more, because that inflation problem is going away. But if it hasn't fully gone away and the labour market is still very tight, there's a risk there that you open up the purse strings and you just do it at a time when the economy is still on pretty strong footing, and you push the rate of inflation back up. So, that's very much a watch this space. So far, the government has done all the right things on that front, but there's always the risk they jump the gun here and want to spend a bit more before it's actually the right time to do that.
Yeah, certainly something to watch through 2023. So Gareth, just quickly, housing market. What have we seen there, and what is that telling us in terms of how things are shaping up?
Yeah, look, it's softened very quickly. It is the most interest rate sensitive part of the economy, and the lags between changes in the cash rate and the impact it has on the housing market are quite short. In fact, those lags have actually shortened over recent years, and what we see is that when rates go down, home prices are incredibly responsive to that, as is residential construction. And then working the other way, when interest rates go up, it has pretty much an immediate impact now on most housing markets in Australia, particularly those ones that are the most leveraged, and those being our biggest ones. So the fall in Sydney home prices has been incredibly rapid, fastest on record. They're down about 12% now from their peak, and nationally home prices are correcting at a pace of a bit over 1% a month. So on any given month, that doesn't really sound like a big deal, but then if you look at the cumulative impact, it's starting to add up. And the interesting thing is, if you look at the Melbourne housing market, prices there now are only 3% above where they were during the pandemic. So we're not too far off in Melbourne, for example, prices going below where they actually were when COVID first hit. So I think just when thinking about the outlook for the housing market, it's very much conditional on what the RBA does, and it all gets a little bit circular. But our thinking here is that whenever the RBA is hiking or retaining that hiking bias, in other words, they're still putting out the expectation that if they're going to move the cash rate one way or the other, it's going to be up, not down, then the housing market will stay pretty soggy, and prices will continue nationally to trend lower. But I think once it becomes pretty clear that the RBA is done in the tightening cycle, and if anything, the next move is likely to be down rather than up, you'll get that support come into the housing market. And dare I say, if the RBA cuts late next year, like we're currently thinking, then the housing market could be back on very quickly, just given how I think a lot of would-be home borrowers are probably sitting on the sidelines right now, given the uncertainty with what's happening in the tightening cycle. But FOMO kicks in very quickly. And I think if rates go down, you can see the auction clearance rate just blow back up within about 5 minutes of a cut.
Well, yeah, I guess that just depends on how much damage is done to, as you say, the sort of the pent up savings in the economy throughout 2023. So you mentioned rate cuts there. Let's just go there for a minute. So you've got rate cuts into the back end of 2023. Let's just go to that point. What is it that you look for a signal for the RBA to go there, and what's got you so convinced that that's going to be the case?
Well, the way we sort of think about the RBA and the policy response from them is to basically have a set of economic forecasts and say, if our forecasts are going to come to fruition, what would be the appropriate policy response to those forecasts? And we think that as we go through next year, the unemployment rate will be edging up. That's not going to happen right now. In the labour market, it's incredibly tight, and job ads are still very elevated, albeit they've come off a little bit. But given how much tightening the RBA has put through, where the cash rate right now is quite contractionary on our estimates based on where we think the neutral rate is, which is about 100 basis points lower than the RBA has it pegged, then what that means is that the economy, by definition, will grow below trend as we go through next year, and that means the unemployment rate starts to edge up. Now, our thinking here is that the RBA is fine with the unemployment rate going up a little bit, given it's so low, and that's probably required to take a bit of heat out of things. But once it is moved north of 4%, which we think happens in the back end of next year, and it's directionally rising, it's an uncomfortable place for the central bank to basically see a jobless rate trending up. And we're thinking that if the wages side of things is behaved late next year in terms of it being consistent with the inflation target, and directionally inflation's coming down, which is all in our base case forecast, then at some point the appropriate policy response is actually to ease policy a little bit, because you don't want the unemployment rate to be getting back up to the kind of levels it was pre-pandemic, which was actually too high. So there's a lot to play out between now and then, and we're also expecting rates to go up in the short run before they come down. But late next year is where we've got it penciled in that the RBA eases policy.
Yep. Okay. As you say, a bit to play out. And just, I don't think we've covered this aspect, but of course we've still got a big chunk of fixed rate mortgages to roll off in 2023 and 2024, perhaps adding to that sort of delayed impact that we're expecting from these rate hikes, right?
Yeah, that's right. I think it's a really important thing, a really important dynamic. A lot more people fixed than usual over the pandemic because the fixed rates were just so low because of the RBA's term funding facility. but a lot of these fixed rates are rolling off next year. In fact, half of the stock of fixed rates are actually rolling off in 2023. And for borrowers that are on a floating rate, they kind of get it's death by 1,000 cuts, or 1,000 hikes, I should say, as rates are going up. But if you're rolling off a fixed rate, you've been used to this incredibly low rate. Average rate of around 2.25% is what people fixed on over the pandemic. But then suddenly you're rolling off onto a floating rate or a fixed rate, but most people will take a floating rate, north of 5%, given where the cash rate is right now. So that is a massive step change in terms of mortgage repayments, because the interest cost it more than doubles. And so for a lot of home borrowers, they might be spending right now based on what's coming out on the fixed rate loan, and then as we go through next year when their loan rolls off, they'll have to come up with a lot of money to make those additional repayments. We think they'll come up with it because they've been tested. Can you repay a loan at a higher rate? But it will come at the expense of spending. So that dynamic's going to play out next year, and it's kind of like a de facto tightening coming through on the household sector.
Yep, another tightening aspect. All right, so we're up against time. As always, you've covered a lot of ground. So let's just sort of just recap over your central view. So no meeting in January. So you expect a meeting in February. And let's just go back quickly over your forecast, and then I'll wrap up.
Yep. So just one further rate hike to come in the cycle, which we've penciled in for early next year. I think in 2 weeks' time, we'll get a better idea as to exactly where the Reserve Bank's head is at when they put out the minutes for the December board meeting. If they put in there that the board actually debated the case to leave policy on hold in December, albeit we know they increased the cash rate, then that will give us a sense that they're really considering this pause early next year. Equally, if they tell us nothing, then we'll all kind of be scratching our heads, and I think having that extra hike in there makes a lot of sense. So I'd just say we think we're close to being done in the tightening cycle. One more hike, and then as we go through next year and the economy slows, at some point we'll be talking about cuts. The key risk here to our view, as I said earlier, though, is around the wages side. If they stay behaved, then I think we're on the money with our call on the cash rate. If though they end up too strong, then unfortunately we could end up in the place some other central banks are in, where the RBA ditches the narrative around the soft landing and says, unfortunately, we're having a harder one than anticipated or desired.
Great summary. I mean, for those on the call that look at hedging, I mean, when the markets align with your view, Gareth, obviously the forward curve and the cost of hedging is low, and if we see spikes in wages and the forward curve will spike and the cost of hedge will be higher. So there's plenty to look for there in the sort of in the forward curve for all those interested. Look, thanks, Gareth. We'll wrap it up there. I mean, once again, throughout this year, which has been a really remarkable year of volatility, you've brought a real sense of clarity in terms of what's going on and what to expect. So thanks for your insights this morning, and thanks everyone for dialing in. As I've said, it's really important for us to keep you informed, and I hope you found these sessions over the course of the year informative. And if you've got any questions or need any assistance, please reach out to your Commonwealth Bank representative. As Gareth mentioned, RBA won't meet until February, so we'll reinstate this call in and around that time, and we'll let you all know when that's about to happen. But thanks again, and have a great day. And the festive season is upon us, so please have a good Christmas and hopefully chat to everyone in the new year. Thanks.
Thanks, Chris.